Good afternoon, everyone. I am here to give you an update on the international markets. Matt Heckman had spoken a little more towards the domestic markets, and as we get into early May, it's time to talk about some economics, but those economics that are occurring outside of the U.S. The World Bank has recently cut GDP forecasts for upcoming years, and it seems like the appropriate move. Things are definitely looking a little bleak in a global economic landscape. Few things going on. China is, and this is sort of real time with China. We're finding out if the economy is going to really be able to have a good solid growth year. A lot of expectations China would have a real solid growth year on the backdrop of reopening from COVID this year. 2023 is a year for that for them. But very recently, things have really actually not picked up nearly as much as people have expected. So China's growth is predicted to be fairly strong this year because there still is a reopening dynamic, but really, the elephant in the room from large economies growing is India. And very recently, it was stated that India has very likely surpassed China for the largest population. Not only do they now have the largest population, but India has much better demographics than China. They have a young, hungry group of people, young, hungry demographics, and fairly educated workforce. So things are looking really bright for India. Sometimes they, need some commodities, but actually sometimes when the commodity markets roll over, it's good for them. And India is projected to have another solid year of growth. If you look at the past couple of decades, India has been a solid grower, and they're going to continue to be a solid grower. One of the things to think about is, can sort of the torch be handed off from China to India as China faces slowing economic conditions in the decade ahead, and can India sort of take that baton and run with it? Well, first off, China is still 5 times the size of India's economy, so India needs massive growth to offset small drops in China's GDP. What I'm showing you here on this slide is gross fixed capital formation. World Bank tracks some of this for all the economies in the world, or most of them. You can see that almost purplish color for China. It's because China's always been really aggressive at investing in infrastructure and plant and equipment. It's always been a big part of the growth story in China. India has not been as aggressive, but recently we're starting to see things pick up. There's a real infrastructure push in India, and when you start thinking about commodities, you have to think, can India, pick up for China? Can they sort of grow at a much faster clip and create that demand for a lot of infrastructure and commodities? And they should be able to. All the signs indicate there's going to be strong infrastructure growth and capital formation in India for years to come. Some of the geopolitical issues with China benefit India. It still is a democracy. So things should be pretty solid in the upcoming year. Sometimes politics gets in the way, slows things down. Some funding issues can pop up from India from time to time. But India should be a solid grower for this upcoming decade, and should create a lot of demand for capital, should have a lot of capital investment. The caveat to that, though, is that they still, as I said earlier, they're 1/5 the size of China's economy. So they need to pick it up a lot to be able to offset a slowing dynamic in China. And I don't think they're going to be able to the extent needed. So when you think about the global landscape, I just talked about India, and there are other Southeast Asian countries that should have good growth and have young demographics, good growing populations that should help out global growth. But China's still, really the elephant in the room when you think about growth in international markets. And they drive a lot of global inflation. There's the demand for goods and services has been significant, particularly on the commodity side. And their population is still enormous, even if India is, perhaps just past them. There's a big expectation. Well, we've seen COVID has impacted sort of demand in China for through 2022 and into 2023. You can see that this is the Bloomberg Commodity Index. We've seen a declining trend in commodities, and you see this little snap back up as we get into the spring season of 2023. But then commodity prices have actually just recently rolled back over. And so we're not seeing a surge in commodities on China's reopening. I think WTI, the U.S. oil benchmark, even today, it's a big day for a down move. That is down to, I think, around $71, a big down day today. And that is certainly based on U.S. dynamics. But China is an important part of oil prices and many other commodity prices. China PPI prices are actually negative. You can't really see that in this graph, but PPI is a leading indicator of consumer prices, and producer prices matter, and they had that surge that many PPI indices did on the sort of reopening from COVID and global dynamics and supply chains and some of those things that were in play, but now they've turned to a negative year-over-year growth, and that sort of indicates excess capacity. China is still a very big exporter. Will they start exporting some deflation globally? Their shipping rates are dramatically fallen off. There's excess capacity in China, so some of those dynamics when people are talking about inflation. Really, there's actually some dynamics coming in play that could lead to some deflationary forces. As PPI in China has turned negative, and consumer prices are hovering near zero. That's far different than Europe and the U.S. China never really had a inflation problem from COVID. They went through a much different dynamic, but even with their reopening right now, this is supposed to be the surge, and we're seeing a CPI that's approaching zero. It's not going up and to the right; it's going down and to the right. So that is a little bit of a shock actually for the global system, and unemployment is ticked up quite a bit in China. There's a talk of monetary easing. Well, the U.S. and Europe are still, getting toward the end of it, tightening and raising interest rates. There's talk that, China needs to start cutting rates. And so they're in a much different dynamic than the U.S. and Europe right now. And it's being reflected in some of the stock prices. So early in 2023, there was a big surge. And the Golden Dragon Index is U.S. listed Chinese companies, a lot in technology. And there was a big surge, and you had almost 20% pop to start the year in a lot of Chinese stocks. Well, they've given all that back. Part of that is geopolitics. The U.S. and China continue to go down a bad path, but I don't think it's all explained by politics. I think a lot of it is economic conditions have really stalled in China, and that is being reflected in some of the stock prices. China had, if you remember from last year, had the big property developer trouble. Property markets really ran into trouble because of the developers, and there's a big issue in the China property market. And those type of problems don't solve overnight. Some of that stalled growth from property developers is still being felt in 2023, and then there's a wealth effect that impacts consumers, and so some of that stuff filters down over time, And, that and probably many other things are really creating a, tough growth environment for China. So we talked a little bit about the two really important emerging market countries, China and India. There's many others that matter as well, but you start getting into the EFA countries. Japan has had a pretty good year for stock prices, and is optimism warranted is what this slide is titled. Well, economic growth is not supposed to be great in Japan, but it's supposed to be a little better than the US and Europe this year, so that helps. But really, the biggest reason for a move higher in Japanese stock prices this year is there's optimism that sort of the value trap that is Japan stocks may not be so anymore. Japan has always had companies trading below book value, pristine balance sheets, but they don't ever return capital to shareholders, and they don't really do shareholder-friendly things. If they have a money-losing division, they pour money into it to try and fix it versus shedding it or cutting it loose. So, there's always been sort of management issues with Japanese companies, and they deserve to trade at a discount to US and European counterparts because of that. But now, there's just a lot going on, and one bullet point here is Tokyo Stock Exchange is now trying to force reform, threatening delisting for companies that don't demonstrate a better use of capital. A large percentage of Japanese companies trade below book value. Companies that trade below book value, it's really a knock on management. Don't think they're going to allocate capital appropriately, and they're being threatened with delisting if management doesn't improve their ability to drive shareholder value. And so that's a big moment, actually. That's important, and it is driving some different attitudes in management. Buybacks in Japan are at a 16-year high. We're starting to see more and more stories about spinning off or shutting down money-losing divisions that just generally wasn't something you'd see in the past. Pour money at a bad division, hoping to fix it. But now we're starting to see some of that, those smart moves like shutting something down that doesn't really have a bright future. And activist investors getting board seats is not something you would have ever seen in Japan before, but it's starting to happen a little bit. So I think there is optimism should be warranted in Japan. I like what I'm seeing. Europe has a lot of the same issues as the US right now. The one issue they had that was different than the US was their surging energy prices. Those are in better shape. They're not quite back to where they were a while ago, but they're not in a territory that'll just sort of shut down the economy. So energy prices are in much better shape, and so that helps. They do have some slowing economic conditions. They have an inflation problem similar to the US that is being stubborn. They have banking issues themselves. I mean, Credit Suisse is a big bank in Europe. Actually, even today, there was talk of really a surprise from the ECB about how much tightening in lending conditions has occurred in Europe. Just the risk of deposit flight, the same dynamics that are playing out in the US are playing out in Europe, and banks are really tightening up. And inflation did actually come in a little below expectation in Europe. So they have a declining inflation there. They still have stubbornly high inflation, but it's declining. And, there's perhaps hope that even the inflation will decline more than expected. But they have some of these banking dynamics that are filtering through Europe, and so that is more problematic. But nevertheless, I think the stock prices in Europe are more attractive than the US right now. So in an economic environment where growth is similar, I would choose Europe. We'll leave it at that. I don't know if there are any questions, but you can always email me if you have a question. Thank you for your time.